Sunil Kaul is our market master of the day, Asia Pacific equity strategist at Goldman Sachs. Sunil, good to have you with us here. Good morning, Prashant this side. Thanks for your time. If you've had the opportunity over the last 24, 48 hours to speak with foreign clients, what are you hearing, Sunil? From people that we've spoken with have told us that maybe, FIs have been on the sidelines, they've been sellers. They may bring forth some of that allocations of next year to now. And generally, the mood is very positive with what we've seen over the weekend. Go on.
Yeah, right, Prashant. Glad to be back. Listen, you're exactly right. I think foreign investors, which you speak to, people have broadly missed this rally, and so people are very keen to increase their allocations in India. As you said, foreign allocations look very light, and I think if you just look across the globe, where most of the advanced economies are slowing, India still looks like a market where growth is pretty steady, macros are pretty stable, earnings are growing at high to mid-teens. And so I think people are very keen to kind of look at India and increase their allocations. For us, I think we are positive on the market. We are overweight India, and we think it's the best structural growth story within the EM region.
Have you increased your overweight on India, Sunil? Given what we've seen, markets like continuity, and now the political mandate that seems to have come post the election seems to suggest that that continuity is going to last now. So are you more positive on India than you were 6 months back?
We have raised our allocations from being neutral heading into the year to overweight. So in that sense, we are obviously more positive on India. We don't have sort of more overweight than that, but we have sort of incrementally raised our allocations. So we're more positive there. I would say, look, I think elections obviously is a strong and positive catalyst for the markets. Historically, markets are also traded strong heading into the election season. But we also have to keep in mind that there has always been a sort of hope rally previously in terms of heading into the elections because of the expectation of a stable government, whereas the setup right now is a little bit different with the market already, as you said, Sonia, expecting policy continuity. So we think returns will be mostly moderate heading into elections. We think sort of earnings over the next 12 months will be will be driving the markets higher. So we're kind of looking for 10-12% returns for the markets overall over the course of next year.
Hi, Sunil. Good morning. Nigel on this side. The last time we chatted as well, you briefly alluded to maybe large caps are looking better in comparison to the mid and the small caps because some of them could have run ahead of themselves. From the large cap space, where do banks fit in? They have been relative underperformers. Valuations are looking good out there. You have earnings visibility as well. Do you think that will be the pick of the pack from here on?
Yeah, Nigel, we certainly hope so. Look, as you said, we are overweight banks and we prefer banks over the NBFCs here. I think, as you correctly pointed out, I think the earnings visibility still remains pretty strong on banks. The loan growth still remains pretty healthy. The capital ratios are strongest they have been in last 10 years. Valuations, as you said, are inexpensive. I think it's a sector where valuations are still kind of mid-cycle overall. I think our sense is that as heading into the elections in the next couple of quarters, the market goes back towards large cap quality names, banks should be able to perform better in that environment. Especially, I would say, I think for the banks, large private banks, which are more geared towards commercial retail, SME lending, corporate lending, as opposed to consumer lending, those banks should be doing fairly well.
Sunil, you guys have written extensively about the Make in India theme, right? Manufacturing, right. PLI schemes and the implications, etc. From that, in that area, what are the best ways to get exposure to that theme? Are these the contract manufacturers, electronic contract manufacturers? Is it something else? What are the best ideas?
Yeah, contract manufacturers for sure. Look, Prashant, we like the broader manufacturing space still as a medium-term themes, but given how much prices have run up there, we're kind of much more targeted. So if you look at the broader investment cyclical universe, I would say we are most positive on cement there because it also plays into the stronger real estate construction cycle. Within the infra, I think in the next couple of quarters, probably the names that are more exposed to public infra capex, their earnings growth is likely to be kind of muted over the next couple of quarters, especially because of sort of new orders not coming through as strongly. But I would say there are other segments, for example, transportation, logistics, which we still are keen on, especially given the structural theme of shifts from unorganized to organized sector. And as you mentioned, the execution, pickup of execution in the EMS segment, given the Make in India and the PLI. So we still kind of like that space. Apart from that, I would say if you look at the real estate, there the property developer stocks have already run up, and they're probably factoring in the next couple of years of growth already. So we are more market weight that space, but we like to play that through building materials, not just cement, but the broader sort of material space, which will include, for example, tiles and sanitary laminates and all of those. So I think we need to be a little bit more targeted, especially in the next sort of a couple of quarters there.
You know, Sunil, getting into an election year as well, cement could look up, consumption will move up, you know, infra push as well is likely to come about, and the housing sector is doing well. But what's your preference from the cement pack? And I ask you this is, because the large were getting larger, but now some of these smaller names, well, they're coming up for sale or, you know, mergers, acquisitions, and that's where the real value is unlocking. So do you stick to the large names, or do you believe some of these mid caps, they offer more value?
Yeah, I mean, we still have, I mean, within the broader cement pack, we still have buy ratings on some of the large caps names, the biggest kind of cement manufacturer in India. So from that standpoint, I think we will, as I said, our preference overall over the next couple of quarters is looking at kind of large caps or mid caps, and I think within the cement pack as well, our preference will lie into some of the large cap names there.
Sunil, what's the big top-down global equity call for 2024? Because in the last 2 months, the macro headwinds have eased, whether it's oil prices, the price of dollar, yields have come off very significantly. And now we're staring at the prospect of no recession in the US. They've pretty much managed a soft landing despite the sharp increases in interest rates. So what's the global equity call for next year?
Look, I mean, we, as you may know, Sonia, we never had a US recession in our forecast. We always had a soft landing view, and seems that the market is also kind of coming to that view. But as a consequence of that view, we also think that Fed doesn't need to cut rates anytime soon. So we have a rate backdrop, in which case we think rates will be higher for longer. So we don't see Fed cutting rates until Q4 of next year. And so if you sort of therefore look across the world, we do think if rates are going to be higher for longer, there is not as much juice from valuation re-rating from current levels across equity markets globally. What that means that you will have to rely on underlying earnings to drive your markets higher. So in all the sort of major regions across the world, in terms of US, Europe, Japan, and Asia Pac, we are kind of looking at earnings growth more in the high single-digit territory. Asia, obviously, there's a large dispersion within that. But broadly, as an aggregate group, we are kind of looking at 8-9% aggregate earnings growth across the geographies. In which case, our global equity returns across these 4 regions are sort of in high single-digit territory. So we're kind of looking at an environment of modest high single-digit returns for the broader markets. And within that, if you sort of pick the pockets rightly, we think for markets where earnings delivery is stronger and India kind of fits into that bucket, you could see even stronger returns.
But will the markets be disappointed if we see Fed cutting rates only in the last quarter of next year? Because market right now is penciling in cuts of 100 to 150 basis points next year.
That's right. I think we do think market is pricing in a bit of too much easing in the curve. And so from current levels, we don't think, whether it's kind of looking at the short end of the curve or also looking at the US 10-year rates, we don't think rates go materially lower from current levels in the near term, right? So from that standpoint, we do think the market may need to kind of reprice some of those expectations which have been built in. Because as I said, the underlying fundamental reason for that is we do think that the underlying US economy is still strong, and Fed therefore doesn't need to cut rates anytime soon. I mean, if we do see growth data worsening, and then the Fed could have early rate cuts in terms of more insurance cuts, but we don't see the need for that at this point in time. And so by the way, that kind of extends. Sorry, I was about to say, I think that extends to our view in India as well, because where we think that RBI will stay on hold pretty much for until Q4 of next year, and even when the rate cutting starts, it will be much more a shallow cycle for RBI too. But that is also contingent on our global view, as I said.
Well, central bank action aside, Sunil, what's the other big risk for the Indian markets? For the time being, things are looking very good. You know, the flows are coming in there. We are likely to have good leadership at the center. 2024 continuity of the current ruling government. Crude oil prices refuse to move up. Goldilocks scenario for us. Where's the risk coming from? Valuations?
Yeah, I would say, look, Nigel, I think the single most pushback we are having from investors is that on valuations. I think the fact that India's macros have been stable for a while. I mean, the earnings growth numbers have been coming through. I mean, it's been 3 quarters in a row where earnings are coming in better than expected, and people kind of understand that story now. But I think the pushback we still get is that valuations are somewhat still on the expensive side. What we would note, by the way, is that if you look at the market, which is obviously at the all-time highs, but the multiples are not at peak multiples. So a year or so back, market was trading, this is MSCI India in aggregate, 23, 24 times forward earnings. Right now, we are more like 20, 21 times. And the reason for that is if you look at the underlying earnings that have grown this year around sort of 18 to 20%. I mean, the 3 quarters for the 9 months of calendar 2023, earnings have grown close to 30%, but even with some kind of base effect, but even sort of incorporating all of that, we think earnings in calendar 2023 would be north of 20%, for example. And if the underlying market is only up 11, 12, 13%, that means effectively your markets have derated. So I think what could happen is that you have another year of strong earnings, and if the market, if you're right, is only 10, 12% up, the multiples would start looking even more reasonable. So at this stage, the fact that you haven't seen flows come in as much as it should have been given in India's stable macro is partly because of valuation. I think as the market kind of digests some of these valuations by underlying earnings, you could see more flows come back in.
Okay, Sunil, we'll leave it there. Thank you very much for your time. Great speaking with you here on CNBC TV 18. So that's the perspective coming in from Goldman Sachs, one of the top sort of sell-side research houses with the perspective.